Yeah, we are in the process of completing our direct tax DT final revision, right? So we will start now international taxation. In taxation, there are mostly three chapters which are very important. Out of which one is DTAA, that is double taxation avoidance agreement. Second one is transfer pricing, and third one is NR taxation, that is non-resident taxation. Now we'll start our topic with NR taxation, non-resident taxation. So here, when we discuss about non-resident taxation, here person, we already know the definition of person. Person has been defined under section 2 subsection 31 of the Income Tax Act 1961. Person includes what? Person includes individual, HO, POP, BOA, artificial judicial person, any partnership firm, local authority, and artificial judicial person, whether incorporated or not. All these are considered as persons.
File this.
Just wait. Yeah, all these are considered as persons. So in this, when it comes to individual, here individual can be a resident, or individual can be non-resident, or individual can be a resident but not ordinary resident. Depends upon number of days he's staying. Resident or non-resident, or resident or ordinarily resident will be categorized. When it comes to scope of total income of in respect of resident, here global income is taxable, that is Indian income is taxable and foreign income is taxable. In terms of non-resident, only Indian income is taxable and foreign income is exempt. In terms of resident but not ordinarily resident, Indian income is taxable and some part of foreign income is also taxable. When the foreign income is taxable in case of resident but not ordinary resident, if the foreign income is earned by where the place of effective management or controlling from India, or it is connected with India, then that foreign income is also taxable in respect of resident but not ordinary resident. When we comes to other persons here includes what? Company, partnership firm, other persons. Here other persons, if you discuss about company can be either resident or non-resident. Company means here companies are divided into two categories. First one is domestic company, second one is foreign companies. Domestic company has been defined under Income Tax Act. Domestic companies includes companies which are incorporated under Companies Act 2013, or companies which have made arrangements for the declaration of dividend. All these two category of companies are called as domestic companies. When it comes to foreign companies which are not domestic companies are called as foreign companies. So what are the tax rates that are applicable for domestic companies? Obviously we know tax rates that are applicable for domestic companies is the basic tax rate is 30%. The lower tax rate of 25% is available if the companies have the annual turnover of less than or equal to 400 crore rupees in the previous year 21-22. Then they have 21-22, then they have the lower tax rate of 25%, and tax rate that is applicable for foreign companies is 40%. And what are the surcharge rates that are applicable? Surcharge rates that are applicable for domestic companies is 7% and 12%. 7% is applicable when the total income is more than 1 crore rupees but less than or equal to 10 crore rupees, and 12% is applicable when the total income is more than 10 crore rupees. When it comes to foreign company, what are the surcharge rates that are applicable? Surcharge rates that are applicable is if the total income is more than 1 crore rupees, the surcharge rate that is applicable is 2%. If the total income is more than 10 crore rupees, the surcharge rate that is applicable is 5%. And health and education is obviously 4% is applicable in both categories. So when it comes to here, the company can be a resident or non-resident. When the company can be resident, or non-resident, it depends upon place of effective management. POEM concept is applicable only for companies having annual turnover of gross receipts exceeding 5 crore rupees, then only POEM concept is applicable. So POEM is what? POEM means not POEM, it is place of effective management. What is place of effective management? From where the business is actively or effectively managed is called as place of effective management. When it comes to place of effective management, how we have to determine the place of effective management? Place of effective management can be determined by using ABOI test. That is, ABOI test is a test that need to be satisfied. If this test is satisfied, then two consequences arise. First consequence, if the test is satisfied, if the test is not satisfied. If the ABOI test is satisfied, then we can say that the POEM is not in India, POEM is outside India, and he is a non-resident. If the ABOI test is satisfied, POEM is not satisfied, POEM is in India and he is resident. In case of non-resident, obviously Indian income is only taxable, foreign income is exempt. In respect of resident, global income is taxable, Indian income plus foreign income is taxable. So What is ABOI test? ABOI test consists of 4 parts. First part is passive income test. Second part is assets test. Third part is what? Third part is employees test. Fourth part is payroll test. So first part is what? First part is passive income test. Passive income, if the passive income of the company is less than or equal to 50% of its total income or Indian income, 50% of its total Indian income, less than or equal to 50% of its Indian income, income that is generated from India, then in that situation this test is satisfied. If this test is satisfied, then we will go to next test. If the test is not satisfied, then also we will go to next test. Here passive income. When we discuss about passive income consists of 2 parts. First part is it is generating from the sales or purchases that are made through the associated enterprises or provision of services that are made through the associated enterprises. When we comes to second part is related to interest, royalty, dividend and fees as technical services, fees for technical services. So all these are passive income only. Passive income comes under passive income. Now we'll comes to second part. Second part is what? Second part is related income. When we discuss about income, here income will arise only when the assessee has computed his total income. So there are two situations where the assessee is required to compute his total income, where the assessee is not required to compute total income. For example, in some of the countries, like there are tax haven countries, so means no tax is required to be payable on the income that is generated by the person. So in those countries, so there is no requirement of computation of total income. So those countries that are required to compute their total income, those persons that are required to compute their total income in those countries. So here passive income is nothing but the passive income that is displayed in the total income or disclosed in the total income, or total income is passive income. We will take that as a basis. If those companies in those countries where the person is not required to compute his total income, then in that situation, so here passive income is nothing but income that is generated from the books of accounts is nothing but passive income. Now we will go to second category. Second category is assets category. Assets category is what? Assets category includes that is the total assets of the company or less than 50% of the assets that are in India. Assets that are situated in India. 50 total assets of the entity are less than 50% of the assets that are situated in India. For example, here assets include, assets are divided into 2 categories, that is depreciable assets, non-depreciable assets. Depreciable assets, in respect of depreciable assets, we will take average of opening balance plus closing balance, or beginning balance plus ending balance divided by 2. We will take average of assets. In respect of non-depreciable assets, we will take value as per books of accounts. This is in respect of assets. Now we will go to what? We will go to third category. Third category of test is nothing but employees test. The number of employees that are working in the company are less than 50% of the employees that are resident in India and working in India. Here when we comes to this category of test, here employees number of employees should be resident in India, and also less than 50% of the employees that are resident in India are working in India. If this test is satisfied, then we will go to fourth test, that is payroll test. Payroll test is nothing but the total payroll or compensation that has been incurred by the company on the employees is less than 50% of the total payroll expenses that has been incurred by the company. Then in that situation, fourth test is satisfied. If fourth test is satisfied, if all the 4 tests, here payroll composition includes whatever the amount that will be payable by the company to the employees is comes under the payroll compensation. It can be bonus, it can be salary, it can be basic salary, it can be perquisites, it can be allowances, it can be compensation that is any leave travel concessions. It can be in the form of contribution to pension fund. It can be in the form of contribution to provident fund, pension fund, gratuity fund. All other contributions will be included in the compensation amount or salary compensation amount to the employees. So this is salary compensation amount. Now we will go to next step. Next step is we have to consider whether the 4 tests are satisfied cumulatively. Then we can say that ABOI test is satisfied. If ABOI test is satisfied, then in that situation the poem concept is poem is outside India. If poem is outside India, the person will be considered as non-resident. In respect of non-resident, only Indian income is taxable, foreign income is exempt. When it comes to ABOI test is not satisfied. If ABOI test is not satisfied, then poem is in India. If the poem is in India, then in that situation he is considered as resident. In the case of resident, global income is taxable, Indian income less foreign income is taxable. Here in respect of ABOI test is satisfied, there are two categories, right? Even the foreign companies, in the case of foreign companies also ABOI test is satisfied, they will be considered as resident. Indian companies obviously they are compulsory, they are considered as resident only. Indian companies will always be considered as resident. So foreign companies, if their poem is in India, then ABOI test is not satisfied. If the poem is in India, they will be considered as resident. Merely if the poem is in India and non-resident is considered as resident, it doesn't mean that the foreign tax rate applicable for foreign companies will change. The tax rate that is applicable for foreign companies is 40% only, even though they are considered as resident due to poem concept. Their tax rate is 40% only, and their surcharge rates are 2% and 5% only. 2% and 5% only. Now 2% and 5% only. So this is the poem concept. If poem concept, in respect of poem concept, this poem concept is useful for determination of residential status of companies. For residential status of companies. Now we will go to what? We will go to next part. Next part is what? Next part is related to scope of total income. Scope of total income includes income that is earned. It is divided into two categories, that is income earned and received in India, income deemed to be accrue or arise in India and received in India. Income received or deemed to be received in India. Income accrue or arises or deemed to accrue or arises in India. These two are included in scope of total income. So here these two are included in scope of total. Yes, wait.